Alright, let's keep moving forward with this same transaction. We sold 2 of the monitors for $1,000 per unit on account to RJ Travel Agency. So we turned around and we sold those computer monitors that we bought for $600 for $1,000 instead. So we've got a little bit of gross profit here that we'll look at on a different statement. But to start with, how do we enter this statement on the inventory system? So the first step is that we are going to reduce the amount of our cost of goods sold, right? We had cost of goods sold. We had inventory that were decreasing by $1,200. We had 2 computer monitors. We paid $600 a piece for each of them. We're going to decrease that account or credit it by $1,200. That's the bottom left corner there. The offsetting transaction to that is the cost of goods sold, which is on the debit side. The cost of goods sold is going to be an expense account. It's on the income statement. And a debit will increase the size of that expense. So we are going to change our inventory to an expense here. We had money. We had money's worth of inventory. We sold it. We're increasing the size of our expense. But that's okay because we've increased revenue here too. In fact, we've made a nice profit on it. So we're going to credit our sales account. The sales is a revenue side account on the income statement. So that we see the $2,000 credit there because we sold 2 units for $1,000. Now remember the matching principle. We're recording that as a receipt of money now. We're recording that as income earned on the sales side, $2,000. But we haven't actually gotten the cash yet. So to be able to represent what we're getting paid for, we have to include an accounts receivable item. Accounts receivable means we are owed money by the RJ Travel Agency. So we're going to debit that, which is an asset, by $2,000. So we've got $2,000 debit, $2,000 credit, we're balanced on that side. A $1,200 debit, $1,200 credit, we're balanced on that side. We're all set.